factors that affect mortgage rates and what we need to know about their fluctuations, also how to time the market. That is the topic for today. I'm Robert Niazov, your trusted mortgage source. I'm representing R&J Capital Group. We are a multi-state licensed mortgage broker, and I invite you to listen and watch this video to the end. A lot of great information is coming. We're going to talk about how the geopolitical situation may affect mortgage rates, the internal events, let's say, in the US, and in general how it works. But most importantly, when and how you can take advantage of the better rates versus higher rates. Is there such a thing? That's also going to be discussed today. So I'd like to begin with just a general theme. Mortgage rates in the US follow what's called a 10-year bond, or yield on a 10-year bond rather. So what is 10-year bond? 10-year bond is a security offered by the United States government for sale in return for some interest from the government. For example, you would like to invest, let's say, $10,000 in the United States government bond, in a 10-year government bond, because there's a lot different, what they call different maturities. There's one with 1 year, there's one with 3 months, there's one with 30 years, but 10 years is a very popular one. Today, at the end of 2024, that bond pays anywhere around 4.3, 4.4%. What does it mean? If you invested $10,000, you tell the United States government, okay, you can buy this, by the way, through your brokerage. Here, I'm investing $10,000. Then each year you will be getting about $440 in interest. In addition to your principal, you will then take your $10,000. It works a little bit differently, but that's the idea. You will get 4.4%. Now, and that's individual. Banks, companies, many times even countries are interested in this security. China buys a lot of it. European countries buy a lot of it. Why do they want to do this? Why do they want to buy this security from the United States? The answer is it has to do with the fact that it's backed by the United States government. They know that we have laws here. We're a country of rules and regulations and laws that people follow. And the government is considered to be the most stable in the world. And that's why banks, as I said, institutions and countries invest in it. Now, the way it works is the following. Because, like everything in life, supply and demand, if people buy this security, or again, organizations, countries buy this security, when there is an increased demand for this, naturally the price of the security goes up. And when the price goes up, the way bonds work, the yield goes down. So it's going to pay less. However, the mortgage rate's also improving. Negative part about this is that they usually buy this security when things are not so stable in the world. Wars break out, okay? Economy in those countries is not so good. Even there could be some events in the United States where these organizations are not very comfortable investing, let's say, in stocks or maybe even real estate. They resort to this security, they buy it, yield goes down, rates go down. And vice versa. When things are good and stocks are doing really well, other securities or real estate is doing really well, and they can invest this money somewhere, or they invest in maybe other countries, because there's very little demand, price goes down, yield goes up, and the mortgage rates go up. So what you need to know, the 10-year bond, yield on a 10-year bond, and the mortgage rate are very correlated with each other. And the chart is here to my left on the top. It shows over the past 50 plus years what their relationship has been. Other factors that affect the mortgage rates is obviously the situation in the economy. Jobs, how many jobs are added, how many vacancies are there. If there is a lot of vacancies, then people are hiring, then there is some confidence in the economy, and usually yield goes up because, again, those companies invest in maybe in the stocks of other companies. They don't invest in the 10-year bond. price goes down, yield goes up. Geopolitical factors, when wars break out or wars end, that also has an effect. If, for example, when, let's say, the war, with God willing, will end between Russia and Ukraine and the wars in the Middle East, we obviously want them to end in any event, but also when that happens, that's going to be a good news, okay? So when it's good news, usually rates go up. When it's bad news, they usually go down. And the example of it is, for example, I'll give you two situations where I personally experienced it right away. Number one was right after 9/11. In 2001, right after that horrible tragedy, rates went down in the United States. And they remained low for many years, but they really hit the bottom after the pandemic. When the pandemic hit, the 30-year mortgage rates, they were sometimes starting in the twos, which was not unheard of. Right now, they are in the mid-6s to 7, and to me, that's the average healthy range for mortgage rates. I think it's very healthy that the rates will be anywhere between 5 to 7% for mortgage rates. Whether we're going to see again 2 to 4%, if that happens, that means there is something bad happening out there. So I don't think that anybody should want this. But 5 to 7 is healthy. Not to mention that, in the 80s, the rates were double digit, 11, 12, 13, 18% even. I remember when my uncle bought a home, I was a young kid back then, going to college. It was, in the 90s when he bought a home in the United States. He basically paid $975, and it wasn't even a fixed rate. About this in a minute. It wasn't even a fixed rate. He paid $975. He paid a lot of money for that rate. He was so happy that it wasn't a double-digit rate. And it was probably like 1992, 1993. Later he refinanced, and you can always do this when the rates improve. Let's talk about one other thing, 30-year fixed rate or 20-year fixed or a fixed rate versus adjustable. So we have in the United States, we have a privilege that we have the 30-year fixed rate. And it goes back again to what I was just discussing with you a little bit earlier. United States issues these securities, these bonds, and the mortgage rates are attached to those bonds. In other words, this 30-year fixed program is only available in the United States. I don't know where else it's available in the world. I know that definitely our neighbors like Canada and Mexico, they don't have it. You can lock into the rate, let's just say it's 5.5%, and you have the peace of mind knowing that it's not going to go up. Again, not everybody is that lucky. I don't think there's any other country in the world that has it. Now, the adjustable rate, where the rate is only fixed for a short period of time, let's say 3 years, 1 year, or 5 years, that is available widely in the world. The downside is that after 5-year period or 3-year period, whatever your rate is, it will adjust to that market rate at that time. So for example, right now is end of 2024. Let's just say you close the mortgage with a 5-year adjustable rate. At the end of 2029, it will readjust to the rate at that time. Now, it might get better. If the rates are better at that time, you will get a little better rate, but you don't have that security knowing that it's going to adjust. At this time, some of our clients in this office that, let's say, closed 5 or 7 years ago, there is also a 7-year adjustable. They're calling us and saying, look, you know what, I had 6%, now all of a sudden it's 9.25. Please help us refinance. So it's, at that time, by the way, it was really making sense for them, because the idea is that the adjustable rates, why would anybody take them if both are available? The answer is this: sometimes adjustable rates have better and lower beginning rate. In other words, if the fixed rate, for example, were 7, adjustable could have been 6. It's not the situation at the moment, it's not the fact at the moment, but that's how it usually is. The adjustable rate usually is lower than the fixed rate. So that's why people and future homeowners take it. How does mortgage rate affect your payment? So obviously, the lower the mortgage rate, the lower your payment is. We just cannot dictate what it should be because obviously these are all market forces. But it's very simple. A 4% rate will yield you a lower payment than a 6% rate. Is it the reason not to buy a home and wait? Absolutely not. You see, the more you delay, few things happen. First, you continue renting and throw money out. Number two is the prices for homes are going up, usually with time. So many people ask me how to time the market. What do we do to find, to know that it's the lowest rate and we should lock in now? It's very hard to do. I would not even bother with this. Leave it to your professional, mortgage professional. As long as you work with someone who is knowledgeable and really is on your side, that's the best you can do, because you can never know. And rates do not fluctuate like, okay, you wake up today, it's 6%, and 2 days later, it's 4%. It's usually a slow movement upwards or downwards. So if you're in the process to buy a home and it takes, let's say, 3-4 months, and when you started it was 7, it's unlikely it's going to be 5 or 9. It will probably be closer to that. Although when the rates started going up in 2022, then they went up violently. Not 1% a day, but it was pretty violent that they went from 4% to about 7 in a matter of maybe 6-7 months. It's impossible to time the market when it comes to mortgage rates. So please don't try doing it. Just go with the flow. If you get into a situation that your rate is 7%, there will be 5%. You can always refinance. So that's about this. I hope this was helpful. I would ask you to please comment, like this video, ask a follow-up question if you have any, if there is something that you need us to maybe explain a little bit better. We would love to do it in the comments, and also suggest more content. Would love to come back with it. God bless you all.